I was struggling with number 3, but I got the answer. It's
Okay, just put an arrow telling me to look over there. Thank you. Are there any more quizzes out there? Please bring them in.
Almost there.
Close.
Really sorry about the phone. So
A little bit what?
my alarm went off.
Oh, don't worry about it. It's not me. No.
I had a question about the quiz. Is it okay?
Oh, after the quiz. So.
Oh.
Okay, folks, let's get settled in. Okay. That's it. That's it, just blank. You can throw it in the recycling if you want. Yeah. Okay, folks. Reminder again about the project, in case you needed it. I will send a to-do list tomorrow with what right from the beginning. For those of you who might not have started yet, I hope there aren't any there's nobody here. I know, but hopefully, you move down the list. I'll send you the to-do list tomorrow. The third quiz obviously is now over. So here's what I've asked Luis and Miguel to do is they're going to, as soon as I grade the third quiz, obviously, which I hope to do soon. I have an 8 a.m. flight tomorrow, so soon has to be before the 8 a.m. or I'm taking the quizzes with me. So as soon as the grades are done, I'm going to ask them to put into NYU classes. Part of the reason is I want you to check your grades because a few of you have had regrading. I want you to make sure that the grades are recorded right. And I'm going to send you a grading spreadsheet, which is what I use to grade you, where you can enter your grades on the 3 quizzes. You can enter what you got on the case. And obviously, you don't know yet what you get on the final project, on the final exam. But if you enter in hypothetical scores, you'll see a grade pop up. Okay? So at least based on last semester's template, you can at least see what kind of grade you need to do it. And there's an option I've never mentioned so far, but I will mention it now that the 3 quizzes are done. Even if you've completely screwed up all 3 quizzes, there is a final override option, which means if you get more than 27 on the final, you get a B plus. 28 out, remember it's out of 30, so the template is hit high, right? You're saying, oh, what chance do I? Hey, you never know. Every semester there are at least a half a dozen people who walk in with C's and walk out with A's, right? To get an A, of course, you get 29. So basically there is that option that is out there, which essentially means, and that option actually kicks across, and you'll see it for a B. So basically for every grade there is a final score which will allow you to override your quizzes and get to that grade. So hope is still alive, for whatever it's worth. So you will get that right after the scores have been recorded in NYU classes. Probably Friday or Saturday I'll send that to you. Okay? But you will hear from me repeatedly before Monday, so I'll probably send you emails every 3 hours or so for the rest of this week. Okay? If you're a group that has not got together ever, I would suggest that you at least have a Skype meeting and talk about where each of you is on the project. And I generally don't encourage the jettisoning of group members at this stage. But if you truly have a reprobate, you can't even get to the person, they're not responding to emails, and you're worried about that person essentially dragging them. So use this only as a last-ditch option. If there's somebody in your group, you've tried, you can't get through to them, and you feel that the group is going to be affected, talk to me, because then we'll figure something out about, because some of you have groups of 7 or 8 and you might not quite have a handle on who's doing what. So that's in case you cannot work it through on your own. I'd like you to work it through on your own. Obviously, I don't want to be the group negotiator here, but if that option comes up, then take advantage of it. So did you see the Apple news yesterday? So what did Apple announce? What did they actually announce higher earnings?
No, higher earnings forecast.
Higher earnings forecast. So let's break it down. First, what did they report about? I mean, let's face it, this is about last quarter's earnings. Everything else is kind of hypothetical. What did they report about last quarter's earnings? That iPhone shipments were down 17. Generally, if you looked at the report, basically they said, hey, we're not a growth company. And then they added something to the report. They did a forecast, but they also increased their dividend. Right? Remember we talked about dividends as a signal? I don't know whether this is dividends as a camouflage, dividends as a distraction, but they increased dividends. So today you're going to see the market work through that information. The initial reaction was very positive, but I don't think people are reacting to the right thing. So by the end of today, we'll figure out what people actually thought about the report. Because what I see Apple signaling like crazy is, we're a mature company. Our growth days are behind us. Trust us on this one. And the reason they keep signaling it is people don't seem to believe them. They keep thinking, oh, Apple's a growth company. Where's the growth? And Apple keeps trying to say, we are not a growth company. Look, we'll increase dividends. We're buying back stock. In fact, they also announced they're going to buy back more stock. Essentially telling the world, look, we're not finding great investments with this cash. We're going to return the cash. So that dividend signaling story, you're going to see it play out with Apple today. So let's continue with that dividend story. Okay? We looked at the dividend matrix. Basically, the two things you look at when you assess dividends are, what are the dividends relative to free cash flows equity? Are you paying out more, less, or about what you can? And then we looked at, do you have good projects, bad projects, or neutral projects? So I'm going to take what we talked about last session and make it into a matrix. So in this matrix, on one axis, you have projects, good to bad. And in the other matrix, on the other side of the matrix, you have how much cash is returned relative to free cash flow equity. So let's take the top right-hand box there. These are companies that are accumulating cash and have good projects. So if you take a Google in there, say, that's where I'd put it. Even though Google had a bad couple of days, as you saw, so even these things can shift. So if you have a company which has good projects and it's accumulating cash, it gets the maximum flexibility in terms of accumulating cash. There's no stress put on it, no pressure. Basically, you're allowed to accumulate cash. If you're a company that is accumulating cash and you have a history of bad projects, you're exactly the kind of company that's going to get targeted to return cash. The activist investors focus on it. If you're a company which is returning too much in cash and has good projects, you're hurting yourself in two ways. One is you're returning too much, and second, you're turning away projects you should have taken. So there you're going to encourage the company to return cash. And finally, the worst case scenario, companies with bad projects that are paying out too much and you're not sure where to start. And there I said you've got to go back to the source of the problem, which is if you have an investment problem, you can't fix it by just fixing dividends. So let's take a few examples. I'm going to start with an unrelated example. Then I'm going to take my 5 companies through and we're going to play a little game. But before I do that, let me take Microsoft. I showed you Microsoft in 96, right? $2.2 billion in free cash to equity, returned nothing, cash balance went up. 97, another $3 billion, 98, $5 billion. And each year it kept accumulating cash. In fact, by the end of 2002, it had $43 billion in cash, which at that time was a huge cash balance. I think it was the largest cash balance accumulated by a company at that point in time. And I checked all the news stories, equity research reports, and at the end of 2002, there was absolutely no pressure on Microsoft to return any cash. Nobody was complaining about the cash balance. And the reason is simple. Microsoft went public in 1986. By 2002, it was already the largest market cap company in the world. As a stockholder, what do you have to complain about? Their returns were immense. On Windows and Office, they were making 50% returns on invested capital. They had a great track record, and people seemed to be okay with the cash balance. 12 months later, Microsoft paid, at that point in time, again, the largest dividend in history. They paid a special dividend of $33 billion. And investors were asking them to return more cash. In 12 months, they went from a company with no pressure to return cash to this company that returned $33 billion cash and felt even more pressure to return cash. So what happened in a 12-month period to change perspective on Microsoft so much? First, there was a macro change. There was a tax law change. Remember that tax law change we talked about in 2003? That was the first year of the new tax law coming into effect, where dividends and capital gains finally were being taxed at the same rate. So one is the tax law change. The other was you had an antitrust effort against Microsoft, where the Justice Department said they were going to try to break Microsoft down because of monopoly into its operating system and into Windows and Office. They escaped that final breakdown, but there was talk about the monopoly power being broken down. That scared investors. Essentially, investors who were okay with Microsoft accumulating cash all of a sudden started worrying about the cash. What I'm saying is, you can have a company have the capacity to accumulate cash, and in the space of a few months, you can go from being a company with absolute freedom to a company with constraints put on you. So here's what I'm going to do. I'm going to play the role of the CEO of each of my companies. I'm going to take Disney, then I'm going to do Vale, I'm going to do Tata Motors, and you're going to play the role of shareholders in my company. Remember, this is your money you're worried about. And I'm going to get up there and make an effort to ask you to trust me. And let's see if you trust me. And you're going to base it on the numbers, so I'm going to give you as much of the numbers as I can so you can make the judgment. So let's start with Disney in 2003. Here's what Disney in 2003 looked like. But in the previous 10 years leading into 2003, Disney generated about $969 million in free cash flows to equity every year. On average, it returned about $639 million in free cash in dividends and buybacks every year. So if you take each year, they're returning about $330 million less than they could have, and that's accumulating where? As a cash balance. So if you take 330 times 10, that's $3.3 billion, and you add interest on top of it, they had about a $4 billion cash balance. So you ready? I'm the CEO of Disney. I say, I have $4 billion of your cash. I want you to trust me with the cash. And then in a moment of honesty, I say, oh, let me tell you how I've done for you or done to you. Between 94 and 2003, the return in equity I've earned on your projects is about 2% less than your cost of equity. And on your stock has delivered about 3% less than the cost. My Jensen's alpha is negative. My excess returns are negative. And most of it came from a big action I took 7 years ago when I went out and bought Cap Cities for $18.5 billion, and the acquisition hasn't paid off. So what do I want you to do? Trust me. And who's the CEO of Disney in 2003? Michael Eisner. So remember your history with Michael Eisner. He's treated you like dirt for 17 years, and now I'm getting in front of you and say, trust me with your cash. Would you trust me with your cash? And in fact, that's exactly the reaction Disney got in 2003. Eisner was surprised. He said, you don't trust me? No, nobody trusts you. And your history with the company makes it worse. I tell CEOs, be careful how you treat your stockholders in the good times, because there will be bad times. And when there are bad times, if you've treated them badly, you've accumulated no goodwill. So in 2003, there was tremendous pressure on Disney to return cash because they were terrified that Eisner with his ego would go out and do another big acquisition. So 2003, Disney had absolutely no freedom to accumulate cash. So if you look at 2003, they had paid out, if you look at the entire period, they've essentially held back cash, and they've used the cash to do an acquisition that didn't pay off, and not surprisingly, they lost the freedom to accumulate cash for a period. Disney, no, in the case of Disney, Eisner got pushed out as CEO in 2005. Bob Iger came in. And we remember the corporate governance changes he made. But here's the other thing that happened. In 2009, I'm now coming in front of you as stockholders again. I'm now Bob Iger, the CEO, and I'm going to ask you to trust me. And now I'm coming from a different place. Over the last 5 years, I actually returned more cash than I had available in free cash flow to equity. So rather than accumulating cash, I've reversed what Eisner did. My stock price, Jensen's alpha, is now a positive number. My return on capital has risen above the cost of capital. I've made my Jensen's alpha positive. My excess returns are positive. I'm returning more cash. But now I have plans for making investments, and I want to start accumulating cash again. So in 2009, if I came to you as stockholders and say, would you trust me with the cash? There's no guarantee that you will, but my hand is a lot stronger because I'm coming off strength. My stock has done well, and I've essentially taken good projects. You're more likely to trust me. See how these things can ebb and flow? Disney today is probably in a pretty good shape to go out and say, trust me. Why? Well, the Avengers made $1 billion plus over the weekend. That helps. But more importantly, that the first streaming numbers, the first stream, the stock has done well. People feel pretty good about them. But that too can pass, right? All you are 2 bad earnings reports away from that slipping away. But you can see how trust ebbs and flows, and how your freedom to do things ebb and flow with what happens to your company. The ultimate argument for flexibility is to go out and deliver. Deliver by taking good projects. Deliver by having a good return on your stock. And if you do that, you will get a lot more freedom to do the things you want to do. So in 2013, Disney had been returning a lot more cash. So it would return to holding cash now. So 2009, Iger got the okay, started accumulating cash again. It's earning more than the cost of capital. Okay? And if you look at permission to hold even more cash, again, you're going to reassess based on what happened between 2009 and 2013. This is not a permanent blank check I'm going to give you. It's a process which you have to repeat each time. So when you look at your company, you're making a judgment about your company. I'm talking about your project. You're making a judgment about your company based on what you see in the company today, which is part of the reason you can look at a project report on your company from 2 years ago. Trust me, every company that's being done in this class has been done before, unless it's some new company. But it doesn't matter, because looking at the corporate finance project report from 2 years ago is not going to give you a cheat sheet to do what you can do today, because the company itself might have changed. So let me move on. I'm now the Vale CEO, and you're going to be stockholders in Vale. And I'm going to present you the numbers for Vale. So here's what the numbers look like. I've basically taken a 10-year period, accumulated the net income over the entire period, accumulated dividends and buybacks over the entire period. So there are ups and downs. It's a commodity company. So rather than look at the annual numbers, I'm going to look at the average or the aggregated numbers. Across this entire time period, I had a free cash flow to equity of minus 3.1 billion before debt, and minus 1.3 billion even if I count that. So the free cash flow to equity at Vale was negative. Let me pause right there. When you have negative free cash flow to equity, you should be returning no cash, right? they actually returned about $29.6 billion in cash. So if I asked you, does Vale have a dividend problem? The answer is, of course. So I'm going to play the role of CEO and come to you with what seems like a fairly obvious request. We have a dividend problem. We'd like to cut dividends to make our cash flow. So basically, I'm not even going to cut them to zero. Let's cut them by 75%. I mean, for the moment, we don't have the cash flows. Sounds like a reasonable request, right? But why does Vale have this dividend problem again? Remember in the corporate governance section, I talked about Vale having two classes of shares. I told you we're all shareholders, but guess which type of share you own in the company? You all own those preferred shares, which are common shares without voting rights. Remember, all the voting rights shares are held by these 8 entities who are not even in the room, right? They're the controlling entities. So you own the shares, and on those shares you get no voting rights, and in return for no voting rights, what did I give you? Dividends, I promise. In fact, most Brazilian companies have a clause that if you do not pay out X% of your net income, not free cash or equity, in dividends, it can be 30, 40, 50%, then the voting rights are given to the preferred shareholders. So when I ask you to cut dividends, what would you like in return? What are you going to demand in return, or what should you demand in return? Voting rights. And I'm going to think and say, no, I don't want to give you voting rights. And this is a choice that companies in many emerging markets seem to make. They'd rather be in control of a bankrupt company than give up control and have a healthy company. It's almost a choice between, would you rather be in control or would you rather be healthy? And it's amazing how often companies say, I'd rather be in control. Family control companies, this is often the case, where you start paying dividends and you realize that if you stop, you'll have to give up control. You don't want to do that. And it's a choice that many company managers seem to want to make, is go for the control over the health of the company. So when you see a company paying out more than its free cash or equity in dividends, and the managers complain of being trapped, put them on the spot and say, why do you feel trapped? Maybe the choice you have to make is give up some control, give up some voting rights, let somebody else also have a role in how this company is run. I mean, what terrifies me is this new wave of companies that is coming public in the US. All seem to be following the Brazilian script, right? I mean, we thought we were free of this in the US until Google broke the mold and said, we're going to create Class A and Class B shares, and everybody rushed into the breach. So if you look at, at Lyft, you look at Pinterest, every one of these companies, you look at Slack, you have Class A, Class B shares. You're seeing they're all technology companies. There's founder worship. That might explain why those companies have Class A and Class B shares. But how do you explain the fact that Levi Strauss has Class A and Class B shares? The guys who founded Levi Strauss are definitely not there. I don't think I saw a Levi or a Strauss in there. This is a disease that's basically spreading where companies, I wager that many, Kraft Heinz is saying, why don't we have Class A and Class B shares? Coca-Cola, Class A. You'd make your life a lot easier as a management. But this is exactly the consequence you then have to worry about. You're going to see companies put on the spot of, do you want control or do you want health? Any questions on, question? I'm sorry? Oh yeah, sorry. I forgot all about that. Now, we talked about how Vale had a self-imposed dividend payout constraint. Self-imposed because they put these preferred shares out there, and as part of the agreement, they agreed to pay out a certain percent of earnings. There have been actually, I think, 4 or 5 countries where there's been talk about requiring companies to pay out a certain percentage of their earnings as dividends. I think it was the French elections in 2012 or 2013, where one of the parties, the candidate, said we have to require all companies to pay out at least 30% of their earnings as dividends. So basically they mandated a payout ratio. I think in general, mandates are a bad idea, forcing something across all companies. But let's say tomorrow Congress decided that there's too much cash accumulating in companies. You're saying, why would governments care about dividends being paid out? From a tax perspective, when dividends get paid out, you collect more in taxes. It could also be you feel sorry for investors. I think that's way down on the list. Okay? So let's assume Congress tomorrow passes a law that every US company has to pay out 40%, at least 40% of its net income as dividends. So let's think about what kinds of companies are going to be hurt the most and what kinds of companies might even be helped by this requirement. So I'm going to list out companies and you tell me whether this group of companies are going to be hurt or helped by this. Large companies making huge profits. Large company, probably mature, you can probably afford to pay the 40%. You're saying not helped, not hurt. We'll come back and see why they might be helped. So they're probably not going to be affected because they can return what they would have in buybacks and dividends instead. What about small companies losing money? What's the law again? 40% of your profits, right? So basically, you're not affected. In fact, I'll wager that if you pass this law, guess what lots of companies are going to start reporting? They're going to find a way to report losses. Every law has unintended consequences, and this will be one of those things. They'll be expensing everything under the sun. It'll be the exact opposite of what you see. Remember the adjusted EBITDA that companies report to make things look positive? They'll have adjusted earnings where everything looks negative. Okay? High growth companies that are losing money, again, if they're losing money, you don't care. But think about high growth companies that are making money. They look like they're making profits, right? And they are. But if you look at their free cash flow equity, what are these companies going to have? They're going to have negative free cash flow equity often because if you, and now what have you imposed on them? A 40% payout ratio. You're going to crimp them. Now do you see why large companies making huge profits will like a law like this? Because what have you just done? You've handicapped your competition. Companies often shed crocodile tears about government actions. And you know what? In many cases, you don't have consensus among companies that this is a bad idea because some companies say, this is a great idea. Why don't you make it 100% of net income, 150% of net income, because we can raise more capital, they cannot. It's a terrible idea, but all too often you see ideas like this pop up because people think about a one-year consequence. We'll collect more in taxes next year. Companies will pay out more in dividends. In fact, the reverse of this, some politicians in the US are talking about requiring every company to reinvest at least 80% of its net income. Just as bad an idea. Why? There are some companies out there you don't want investing any of their net income back because they're in awful businesses. Requiring all companies to pay out a certain amount or invest a certain amount is absurd because you're going to get some really strange consequences. Let's move on. This is actually a very old case study. About 25 years ago, I was asked by BP to come in and teach a class. It was actually one of the most unique classes I've ever taught. So I flew to London, I show up in this room, there are 20 people in the room, all engineers. So what BP decided to do was pick their brightest engineers from different parts of the world, bring them in, and now my mission was to teach them enough corporate finance in a couple of days that they could go out and be more rounded. You know what? It's the easiest class to ever taught because these guys got it. I mean, they were numbers people. They were bang, bang. The storytelling part they had no interest in. But this return, so think like computing return on capital. There's no logs, no exponents. This is really easy. So as part of the process, what I did was I picked a company that they were very familiar with, which was BP. So I did everything I did on Disney, I did on BP. So we did hurdle rates, we did capital structure, then we got to dividend policy. And I said, let me look at BP's free cash flow equity and dividends. And when I first computed the numbers, I thought I'd screwed up. And you're going to see in a minute why. I computed free cash flow equity for the company on average between 82 and 91 of about $571 million. Again, let me ask you the easy question. If you have $571 million in free cash flow equity, on average, what should you expect BP to be paying out? About $571 million, right? They paid out about $1.5 billion every single year for 10 consecutive years. Now I looked at the debt ratio. Maybe they're under-levered. BP was the most over-levered oil company in the world by the time they got to 91. They were borrowing money to make up the difference every single year. Do you think BP has a dividend problem? In fact, everybody at BP knew they had a dividend problem, including the janitor. Because when he asked for a new broom, you know what BP said, right? We don't have money to buy brooms. We have to pay dividends. This was a company which essentially paid dividends first and then worried about everything afterwards. So you think, how did they get into this trouble? Now, We'll talk about how they got into this trouble in a moment, but they probably started small and they started paying bigger and bigger dividends. And as they kept paying bigger dividends, they attracted people who liked bigger dividends. And remember the word I used, dividend addicts. And by the time you got to 86 or 87 or 88, this company had accumulated the strangest, weirdest group of people ever called investors in a company. Okay? It was every dividend addict in the world was in that room. They were trapped. In fact, let's visualize a BP top management meeting in the mid-'80s where everybody knew they had a dividend problem. See, all were, sit around the table and go, oh boy, we have a dividend problem. Aye, everybody kind of agrees. We should cut dividends, aye, wonderful idea. And then somebody asked the key question, which is, who's going to tell the shareholders? You think, what's the big deal? Remember what he said, you get in front of a bunch of dividend addicts and tell them you're going to cut their dividends, you're not going to make it out of there. So my guess is everybody says, oh, I'm not me, I won't be there at the meeting, I'll have laryngitis 6 months from now. And then, of course, there's always this person at every meeting who comes up with this brilliant idea. He says, let's wait a while. Maybe something good will happen. Which for an oil company is what? Maybe oil prices will go up. There was a brief period in 91 when Saddam Hussein wandered into Kuwait and oil prices spiked. When you could see people at BP dancing on the desk. No more dividend problem, no more dividend problem. 6 weeks later, the dividend problem was back. Finally, in 91 or 92, BP cut dividends. Saying somebody had the courage to do the right thing. You know why they cut dividends? Where did they go get the $1 billion every year to be able to pay these dividends? They went to the bank to borrow money. And how did I describe BP in 91? The most over-levered oil company in the world, right? So they went to the bank in 92 and said, we'd like to borrow $1 billion to pay dividends. The bank finally said, no. They cut dividends. We all agree that this was the right thing to do. They were paying too much. And just to show you there's no justice in the world, this is the article that showed up the day after they cut dividends. BP shares plummet after dividends are cut. I should complete the story. 6 weeks later, they'd recovered fully. And this was, in hindsight, the healthiest thing that BP could have done. But what was happening in that 6-week period? The strangest, weirdest group of stockholders ever accumulated in the company were all running for the exit door saying, this is not the company I want to be in. And a new group, and that doesn't happen overnight. And here's the real consequence. As those stockholders were stampeding for the door, they took half the management team with them. Half of BP's top management was pushed out as a result of this. Dividend changes are never pain-free. But if BP had done something in 86 or 87 or 88, they could probably have been able to manage it. When you have a dividend problem, it's better to deal with the problem early, because if you let it build up to a crisis and then you're forced to deal with it, you get none of the glory of having fixed the problem, and you're going to get all of the pain. So you can see companies sometimes trapped in a dividend policy. You can see they cannot afford to maintain these dividends. But you can also see that the management is terrified of cutting dividends because of what it means for them in terms of tenure at the company. So we talked about cutting dividends, how that's viewed as a bad signal, right? But then again, there can be good reasons why you cut dividends. I remember somebody at last session, somebody said, if I cut dividends and announce something else, is there a chance? And the answer is yes, though the chance might not be immediate. So what this study actually looked at is dividend cuts accompanied by other news stories. So they looked at dividend cuts are accompanied by a decline in earnings. And there, the stock price dropped 7% on the announcement, and it continues to stay down because there's really no good news here. Because what do people say? Well, you cut dividends because you had no choice. Your earnings were down, your business is not doing well, that's why you cut dividends. The second group of companies had announced an earnings decline before. When they cut dividends, you saw the stock price drop, but the continuation is not as bad, but it's still negative. But the third group of companies also announced while they were cutting dividends that they were planning to invest more in new businesses or new projects, presumably in good projects. Because while the initial reaction is still negative, investors can't tell at the time you cut dividends why you're doing it. They often don't trust you anyway. But if you track them through, into the announcement period, which is a week, but you look at the announcement period, You look over the entire period, the stock price recovers. So there's hope here for companies that are trapped in a bad dividend policy and have to take profits. Remember the phone company example I gave? Initially, you might not get a positive reaction. In fact, you probably will not, because everybody lies. But if you can create at least the basis for that dividend being invested somewhere else, stock might react positively by the end of this period. Yes?
So given that, and given like the BP example that this happens all the time, what do you think CEOs and CFOs are most afraid of when they recognize these problems and don't act on them? Like that the short-termism of the market will have them fired before it recovers?
They're worried about the investors in that room because, in a sense, you get the investors you deserve. It's not even about the entire market. It's about their particular shareholders. Because there's a selection bias, right? The people who picked your stock picked it because you paid the big dividend. And now that you're going to announce that you're going to cut dividends, those people are not going to be happy and they're going to sell. What you're hoping is there's enough institutional demand for your company that it'll make up for it, but it's never going to be instantaneous. And you got to hope you outlast that bad period, right? If it's 3 months, you probably will, but if it's a year, you might be gone before the fix happens. So there's no glory for the CEO who actually does it. This is why you're more likely to see this when a new CEO comes in. Because he says, this is the last guy's problem, I'll cut the dividends now. So it's actually an argument for more turnover among managers. Because if you have a problem, you hate to admit to it as the existing management. This is an admission that you shouldn't have paid this much in dividends in the first place. Yeah. And it's also why you see the shift to buybacks. Because the new companies say, I don't want to even deal with this problem, so I'm not even going to start paying dividends. I'm just going to do buybacks. This way I don't have to deal with the consequences of being trapped in a policy I cannot maintain. Yes?
So a company like Coca-Cola, which has done dividends for like 90 years, and their earnings forecasts are worse.
They're flat. They have the cash flows to sustain the dividends, but if the earnings started declining, this is a problem they're going to have to deal with sooner. If they go into decline, I mean, remember, every company, GE at some point in time went into decline. If that starts to happen, my advice to them is get ahead of the game. Now, before the earnings start declining, start packaging your dividend cut, saying, you don't even have to send it. You don't have to be explicit that the earnings are going to drop. People are going to be pissed off if you're explicit. But essentially, the implicit message you're sending to markets is, our earnings have peaked and they're going to get worse. You're saying, am I not signaling back? It's never wrong to signal the truth, right? So if your future looks bleak, it's better to get investors ready for that bleakness early rather than wait for the news to hit them, because it'll allow for the transition again. In the sense, you can almost see Apple kind of trying to get a different investor base in, right? By that increase in dividends, they're saying, look, we don't want these growth investors kind of populating our ranks. Every quarter we're saying, are you getting double-digit growth? We'd rather have investors who buy us for the cash. It's a different investor base. But in the case of Apple, I can see why they want to make that transition, because they're a cash cow. They can pay these dividends till the cows come home. And they're not worried about sustaining the dividends. So every time you change dividends, you're also changing your investor base. And for Coca-Cola, that future investor base has to be ready for this to be a declining, almost self-liquidating company over time, if in fact they've peaked.
Yeah, it's interesting because they do have a very sophisticated investor.
Sophisticated is skin deep, right? So when people tell you they're sophisticated, under the sophistication of a top-notch money manager are all the behavioral things that we all have. So I've never believed in the smart, sophisticated investor base, because once you strip that layer off, we all behave in very, very irrational and emotional ways. So I would not assume that sophisticated investors will get this. So I would start preparing them slowly by perhaps cutting dividends a little at a time, saying, you know what, this is a transition we're making. Yes?
Where do you see the automated investor perspective?
Yeah, they're just noise. See, there's a lot of craziness in markets, right? What you're hoping for is crazy people cancel each other out. You just have to hope they don't get together in a group and run. No, seriously. Even the firmest believer in efficient markets, we have to accept that a big chunk of investors are just noise. They invest on chaos. They invest on I don't know, astrological signs. You just have to hope that their craziness averages out. So to me, those high frequency traders, noise traders, can affect prices, which means in short periods they can make the stock move a lot, but because they come in from different directions, they tend to cancel each other out. So as a manager, I know they're there, but I should never be running a company worrying about what they will do, right? Because they will push my price up and push my price down. My guess is a lot of the buying in Apple yesterday came from those people who trade on earnings reports, often with no basis in fundamentals. It's not like they're revaluing Apple with the new information. So today will be the test of how much impact they have, because much of that impact, if it fades away, is a signal that was all noise. Let's talk about the limited. Limited, and this was a period where the limited, you don't see as many limited stores anymore, but they're still around. This was the period of high growth. They went from a small retail company to a big one. So the free cash flow to equity they had on average over that period was about minus 34 million. Again, a company that on the basis of free cash flow should not be paying dividends, but managed to pay about $41 million in dividends every year. And this is a company which actually has good projects. So you have a company that's growing, it has great projects, and it's paying these dividends when its free cash flows to equity are negative. You say, how do companies get into this trap? I don't know how they did, but let me do a hypothetical. Let's suppose you're the limited, and I come to you, I'm your banker, and I come to you with a proposal. You're not paying dividends, it's 82. You're growing, you have great projects. I say, why don't you pay a token dividend, a small dividend? And here's my rationale for why. There are investors out there, institutional investors, who cannot invest in some stocks because they don't pay dividends. So some pension funds, one of the constraints they have is you can invest only in dividend-paying stocks. I can't believe they keep the constraint in, but there are some investors out there, especially in the 80s. So I come to you and say, you look, pay a token dividend. By paying a token dividend, what happens? You get on those investor lists. Those investors can now buy your stock. It's a question of demand and supply. You've increased the demand for your stock, so your stock price will go up. A lot of young companies get started on a dividend policy, often with this pitch. Just pay a token dividend. What's wrong with that argument? What's a word that I use to describe dividends? Dividend addicts. Have you ever offered an addict a token? Take a little cocaine, but stop now, please. It doesn't work, right? You offer a token dividend, then that's exactly, the limited started by paying $1 million in dividends. By the time it got to year 10, that $1 million had become $101 million. Don't start paying dividends if you can't afford it, because the pressure is always going to be on you to increase those dividends. Why get started in the first place? If you really get to a point where you have the cash flows, then get started. But don't get ahead of the game by saying, let me start with a little dividend, because that little dividend over time will become a bigger dividend. Yes?
What protection advantage do you see such companies have trapping these investors, and why do they want?
Because it's really just a constraint, right? Basically, these institutional investors have always wanted the limit in their portfolio, but because of that, it's an external constraint that's imposed on these portfolio managers that they cannot buy non-dividend paying stocks. By paying that dividend, you're allowing those investors. Why? Well, that's the question. Why do you want the? That's really the pushback you have to have is, and at that point, the response that I've had as a banker is more demand. Why do you want to push away investors? And the argument has to be, I want to push away investors who are not right for me as a company, because then I get trapped into doing things I cannot afford to do. Let's talk about Tata Motors. Tata Motors are on average free cash flow to equity with dividends. So let's give them the credit of about 825 million rupees, but without the debt, their free cash flow to equity was negative. They paid about $75 million again in dividends and buybacks. So this is a company that's paying out more than its free cash flow to equity in dividends, and the only way to cover it is with that. And before I jump down Tata Motors and say you shouldn't be doing it, remember what we had with capital structure, that you had this cross-company subsidy? And one of the problems, again, with looking at a company that's part of a family group is you see it paying more or less. You have no idea why it's doing that unless you look at the family group objectives. Okay? Maybe the family needs more dividends out of one company because they can reinvest in another one. They don't know this might be the way for them to do it. So again, they're paying too much in dividends, but I'm not sure what to ask them to do, because until I know what the family group constraints are, nothing I say is going to make a difference. The problem with family group companies is looking at them individually, you're getting a partial picture. And until you bring in the group objectives, you really can't tell what's going on. So if I had to sum up, here's where you have the matrix. Here's what my companies look like. Baidu had the maximum flexibility. It, of course, paid no dividends and had no buybacks in the 5 years leading in, but it had the maximum flexibility because it had, it was growing, it had high returns on capital, it had the freedom to accumulate cash. Not to mention the fact that even if you wanted to get Baidu to pay more dividends, what's the problem you'd ever run into? Well, remember first, the Baidu you bought as shareholders was the Cayman Islands shell company. And how much can that shell company pay in dividends? Absolutely nothing. They don't even run a beach resort. It's just a little office there. You own nothing. You control nothing. So this is going to become a problem 10 years from now when Baidu is accumulating cash. And I'd like that cash back. Well, good luck to you with that. But you bought into this agreement, right? Because when you bought those shares, you said, I'm okay. And I would say the same thing about an Alibaba. Today, it's a glorious growth company. But 10 or 15 years from now, it'll become a mature company. It might accumulate all of your cash, and there's not a single thing you can do to get the cash back. Corporate governance is always going to be under each of these companies. So take a look at your company. Use the statement of cash flows because everything you need to do dividend policy is in that statement. Compute the free cash flow at equity. Do it not for 1 year, but try to do it over 5 years or 10 years. So it's not rocket science. Just take it out. And then look at the same statement of cash flows to see how much the company has returned in the form of dividends and buybacks. And then tie that with what you found earlier about the company, about what kind of projects it took, what the Jensen's alpha is, and make your judgment on this company's dividend policy based on everything you've learned about the company. One final point. Most companies set dividends by looking at the rest of the sector. So here are the peer groups for each of the companies. And you can see essentially that within each group, why the companies do what they do. Baidu pays nothing in dividends, but guess what? The sector pays very little in dividends. Now, Vale pays a big dividend, but mining companies are notorious for paying big dividends. I remember the name of the CEO who says, I'll cut dividend, over my dead body. It's BHP Billiton. Basically, that's, and if you get a chance, go back and look at the Wall Street Journal, the actual quote. So basically, when you look at why these companies pay the dividends they do, there's a simple reason often that lies by looking at the peer group. And in fact, the Disney peer group you can see has is broken up into big companies and small companies, and you can draw whatever judgments you want. But I've computed the yield and payout ratio for each one. So you can get a sense again of, is my company unusual? And often by looking at the peer group, you can get a sense of where dividend policy comes from. That is often by trying to be like everybody else. Okay. And as with debt ratios, I actually took dividend yields and payout ratios across all US companies, just to see what drives yields and payout ratios. Again, I wouldn't read too much into it. But if you could plug in numbers for your company into this regression, you'd get a predicted dividend yield or payout. And then you can compare it. It doesn't tell you much. It just says, given how other companies are paying dividends, is my company paying more or less in dividends? The variables I used were basically variables that reflect what I would expect drive dividend policy. High-risk companies should pay low dividends. High-growth companies should pay low dividends. If you have a lot of debt, it could cut both ways, basically. You could be paying dividends to rip off your bondholders, because that's or you could not pay dividends because you can't afford to. So it's a measure of how much these are. And with Disney, with their two regressions, I get payout ratios and yields that come pretty close to what they're actually doing. There is a reason why companies adopt the dividend policies to do. So I'm going to pause there, because next session, in the next two sessions, we're going to put an icing on the cake by talking about valuation. Essentially, you can think of it as a preview for my other class if you're interested in being tortured again, or finishing for this class. So on Monday, we will start on valuation.
I have a quick question
Yeah.
about the proposal. So first, can I set up like a date to update everything? So like the share price of like today and reviews across all, or does it need to be like the last day?
Just to set a date.
Okay. And for the free cash flow track, my company's Facebook. Do I like consider to reach the investment, the R&D and operating business, or?
It's already done. It's started net income, R&D is already out the window. Right?
Okay, and the capex and
No, but remember, free cash or equity starts with net income, right? You've already subtracted your R&D. And if you capitalize it, you have no effect on free cash or equity. You just make the net income high and the capex higher. So when you compute free cash or equity, you don't have to worry about capitalizing simply because it's a cash flow amount.
last question.
Do you know of any statistics kind of like companies that have put dividends and announced buybacks at the same time? That doesn't happen often. I was just wondering which crazy drums. The bottom one was only 16.
So my guess is you'll find some things that I've never seen. That'd be an interesting study to look at companies announcing dividend cuts and a buyback increase, or the reverse, because we can get both chances together, then you can see what investors think about dividends versus buybacks almost in the especially the two are roughly the same magnitude. You can see how investors value dividends as opposed to buybacks. But I've never seen it. It'll be an interesting study. I'll look for it. You know where to look for research papers? Go to FCFE.com, which is like the general site for all research done in the social sciences, and every finance working paper that gets exposed to that. So type in FCFE.com, type in dividends and buybacks. Well, there was a time when this was a natural transition that was made. So companies like Coca-Cola started doing it because in those days, that's how companies matured. You were expected to pay dividends once you got it. There was no other option. That's how it was done. So companies like Coca-Cola, they would cut some slack. They started on it in a very different time in the world. And then once you get started, as I said, it's very difficult to step away. So it wasn't even a broad investment. This is what every investor, they bought stocks for dividends in the 1950s.